In this video, I'm going to provide an overview of bonds and how you can use Excel to perform bond calculations. So bonds, corporate bonds, U.S. Treasury bonds, things like that, have specific terminology, and let's look at a timeline for an example of what a bond might look like. The terminology and the way a bond works is that the bond pays what's called coupons, or an amount, say $60 a year, some amount, every year if it's an annual coupon bond. And then at the end of the bond, at its maturity, it pays a par value or a face value. Par and face value mean the same thing. Par and face mean the same thing. So for example, we could have a 5-year bond that pays $60, $60, $60, $60, and $60 in each of 5 years, and then pays $1,000 at the end. Now, you pay a certain amount for that bond if you buy it, and if you put all of this on a timeline, and suppose you purchase the bond for $900, then the timeline of your cash flows would be, I paid $900 right now for my bond at time 0, that would be now, and then I'm going to get 60, 60, 60, 60, 60, and 1,000. So in that final time period, I'm going to get 1,060 for my bond as my return. And the terms mean this. This would be called a 5-year, $1,000 par value bond. So here's the par value. We'd also use the term face value because they're synonyms. So a $1,000 par value bond, which is a 6% coupon bond. And 6% means that $60 is 60% of the par value, whose price is $900. So it's a 6% bond because the coupons are 6% of the par value. If it were a 5% bond, then the coupons would be 5% of the par value. If the par value is $1,000, those would be $50 a year. Bonds can have any par value at all. They can be $1,000, $1 million, $1 billion, $500, any amount. In most examples, we use 1,000 just for convenience sake, but it does not have to be 1,000. All right, so these are the terms for bonds. Now let's suppose that you've got a 5-year, $1,000 par value 6% coupon bond. That would be this one, the one that has 60, 60, 60, 60 for 5 years, and then $1,000 at the end. And suppose that for investments of this riskiness, the appropriate discount rate, the appropriate rate of return is 7%. Then how much should that bond be worth? How much should you pay for such a thing? So maybe you're not going to pay $900, it's some other amount. How much should that bond be worth if the going rate, interest rate or the going rate of return on these bonds is 7%? So this one is locked in place at 60, 60, 60, 60, 60, and 1,000. The question is how much should that investment be worth? Another way of saying this is find the price of a 5-year, $1,000 par value 6% coupon bond with annual payments. So notice that my payments are $60 every year. And when its yield to maturity is 7%. The term yield to maturity means the discount rate that you use for finding the price. Let me say that again. The yield to maturity is the discount rate, the interest rate that you use for finding the price of the bond. So how do we do this in Excel? Well, a bond, just like any other investment, the value of that bond, the price of it, is the present value of its cash flows discounted at whatever the appropriate rate of return is. And in this case, the appropriate rate of return is the yield to maturity. So we've got, I'm going to put all this in an input section. We have a par value of $1,000. We have a coupon rate of 6%. And notice that I'm going to say explicitly that these are annual coupons. We're going to look at semi-annual coupons, which is the way most bonds actually are priced and are constructed in a couple of minutes. But notice I'm going to make it clear. This is annual coupons. And also notice that you need to be really clear about this. The coupon rate, the 6% in this case, is not the discount rate. The coupon rate is the rate that's set in stone that tells you what the size of the coupons are. So this contract, this bond contract is 60, 60, 60, 60, 60, and then 1,000 at the end. That 6% represents these 60s. The discount rate, on the other hand, which is also called the yield to maturity for a bond, that's a different number. So $1,000 par value or face value bond, 6% is the coupon rate, 7% is the discount rate or the yield to maturity. This is a 5-year bond, and let's look and see how we go ahead and how we figure out how much that price ought to be. Well, that price is the present value of this series of cash flows. This series of cash flows is a $60, $60, $60 annuity plus a final lump sum of $1,000. And so the way we input this in, the way that we input this in Excel is we have the present value function. We have a rate. That's going to be what? That rate is our discount rate, so that's going to be the 7%. We have the number of periods. That's 5 years. The payment is $60 a year, but notice I don't have 60 anywhere on my inputs. I have a par value and I have a coupon rate, so the payment is the par value, which is $1,000 multiplied by the coupon rate. That's 6%. So that's what gives right here the $60. Notice the future value is another payment. It's also positive, and it's $1,000. So the payment and the future value are positive in this case. And just like any commercial loan or consumer loan or most other investments, the cash flows occur at the end of the period. And so the type for this, for these $60 a year coupons, is 0 because the cash flows occur at the end of the year. Now, of course, since we're using the Excel PV function, the answer is going to be a negative number because Excel is always answering the question, how much must I pay in order to get? And so when you use the PV function, Excel is going to answer how much must I pay in order to get 60, 60, 60, 60, 60, and then 1,000 at the end. So we're going to get a negative number as the price here. If you want to make it a positive number, then multiply it by -1 on the outside of your function. So $959 is how much this bond would trade for if the going rate of interest on investments of that sort of risk, or the yield to maturity on this bond, were 7%. Okay, so that's how you find prices. It's a present value problem. Now let's look at it a different way. Suppose that you observe how much a bond is trading for. So you look on the Wall Street Journal, or you look on FINRA.org, and you see that a bond is trading for $900. So let's use this same bond. It's a $1,000 6% coupon bond. So $1,000 6% coupon bond, 5 years to maturity. We're still using annual coupons, and you observe that the price of this bond is $900. Well, what would that say about the rate of return that you're earning on that investment? Another word for that is yield to maturity. Another term for that is yield to maturity. Well, in this case, we use the Excel rate function. How do we use the Excel rate function? Well, what the rate function does is it identifies the interest rate that sets the present value of the cash flows equal to whatever the price is. And so in this case, we have 5 years to maturity. So there's our 5 years. That's the first piece that goes into the rate function. Second piece is the periodic payment. And in this case, the periodic payment is $60, but it's 1,000 times 6% because we don't have $60 anywhere in this input section. And I encourage you not to put $60 in the input section. I encourage you to use 1,000 times the coupon rate because this is how bonds are quoted. It'd be quoted as a 6% bond. So we have 1,000 times 6% is our coupon. Notice that the present value now is the amount that you must pay in order to receive. So the present value is $900. That's how much you would pay to buy the bond. But notice I put a negative sign in front of it because I got the price in my input section listed as a positive number. In the rate function, we have to recognize that we would pay, that's a negative cash flow, pay out $900 in order to receive these, so it has to be a negative number. So I have to put a negative sign in front of this. The future value, $1,000, is how much we're going to get at the very end. And of course, this is an ordinary annuity, and so the type is 0. And so when I press enter, I'm going to end up with an interest rate of 8.54%. And of course, here's the formula that I actually used. Now, I do want to note something for you. Suppose, and my students do this all the time, suppose that you forget that the cash flow for your to pay for this bond, the $900, has to be negative. So suppose you, instead of putting a negative sign in front of B36, you just forget to do that. And you just put B36 in here. And so that's basically saying that 900 is a positive number in this formula. Just out of curiosity, what happens? And the answer is, well, bad things happen. You get an error, and the reason you get an error is because the way that I've entered this. All right, so let's look at this. 5 years, $60, 5 years for this series of cash flows. 60, 60, 60, 60, 1,000 at the very end. And the way that I've got this entered is getting $900. So this would be one of those fantastic investments where they give you $900 at the very beginning and then give you 60, 60, 60, 60, 60, and then give you 1,000 as well. Well, what kind of rate of return is that? Well, you've not paid anything for it. It's an undefined rate of return because your payment for it is 0. It's an infinite rate of return. And so you've just basically put in the parameters incorrectly into the rate function. And the rate function is going to answer your question. It's going to say that's a nonsensical question because you don't get a rate of return when you don't have to pay something in order to receive it. So there's, I put the minus sign back in front of B36 so that the present value is in fact a negative number so that you can actually calculate a rate. Now, let's look at a couple of things first. Before I go to semi-annual payments, let's make another note. We have a bond that's $1,000 par value. So let's go ahead and look at this. $1,000 par value. The coupon rate is 6%, and the yield to maturity was 7%. The special case in which the coupon rate and the yield to maturity are the same is what bonds look like when they're originally issued. So, for example, when a company is issuing bonds, they're going to say, okay, we need to issue a whole bunch of bonds. We need to raise $10 million or $100 million or something like that. Each one of these bonds is going to have a face value of $1,000. It's going to have a coupon rate of something. We don't know what that coupon rate is going to be, but the market right now has yields to maturity of bonds of this riskiness of about 7%. For some technical tax reasons, it's way easier for the company and for the investors if the company issues the bonds at such a coupon rate so that the price is very close to the par value. So this situation where the issuing price, if this was the issuing price, of $9.59 and the par value of $1,000, that's a bit inconvenient for investors. And by convention, what companies are going to do is adjust the coupon rate when the bonds are originally created so that when they are issued, they will trade for about $1,000. Well, what would that coupon rate be? Well, it turns out that the coupon rate needs to be really close to the yield to maturity. And in this case, 7% is the yield to maturity. And if I make the coupon rate 7% so that this bond is 70, 70, 70, 70, 70 instead of 60, 60, 60, 60, this price is going to be, well, it's going to be pound, 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 but I'll make it a little bit bigger. This price is going to be $1,000. So the special case when the coupon rate is equal to the yield to maturity, or really, really close to the yield to maturity, is what the situation looks like when the bonds are originally issued. However, after the bonds are originally issued, and so let's again go back to the situation where we have 60, 60, 60, 1,000, so what it looks like. So this would be our 6% coupon rate bond. After the bonds have issued, the yield to maturity is going to go up and down based on market interest rates. If inflation kicks in and interest rates go way up and the yield to maturity for a bond like this ends up being 10%, then the price of that bond is going to go down from its original issue price of $1,000 down to $848. And if it turns out that we go into some sort of recession or we have really low interest rates like we've had since 2009, up until very recently, and interest rates drop to, say, 4%, so that the yield to maturity on a bond like this is only 4%, then the price of this bond is going to increase to some amount over $1,000. So this is really important for you to understand which things move and which things don't. After the bond is created, the coupons stay the same, the par value stays the same, but the market price is going to go up and down based on what underlying interest rates are in the economy. If interest rates go up, then the yield to maturity goes up and the price goes down. So if interest rates go up from, say, originally 6% and up to, say, 8%, then the price of the bond is going to go from $1,000 down to $920. If interest rates go down from, say, an original issue when yield to maturity was 6%, if interest rates go down to, say, 5%, so if market interest rates decline, then the price of the bond is going to go up to $1,043. So another way to think about this is bond prices go up when interest rates go down. Bond prices go down when interest rates go up. And I'm going to say it the other way too. Bond prices go up when yields to maturity go down. Bond prices go down when yields to maturity go up. And for existing bonds, the coupon rates don't change. Once that bond is created and sold to investors, that coupon rate doesn't change, at least not for a fixed coupon bond. All right, now let's talk about semi-annual payments. Most bonds don't make payments once a year. They actually make payments twice a year. And so they're called semi-annual payment bonds, and that leads to a little bit of confusion among students about what they look like. So a $60 annual coupon bond is going to pay those coupons in two $30 payments a year every 6 months. And so when you're doing the calculations, that means that the number of periods is doubled in your calculation from 5 years in this case to 10 half years, and that the coupon rate and the and yields to maturity and everything are halved in order to calculate the coupons, and you have to multiply by 2 in order to get the yield to maturity. So that's all very complicated. Let me explain exactly how that works, first with a timeline and then with the calculation. So consider this timeline. So we've got the same bond, a 5-year bond that has $60 annual coupons. It's a 6% annual coupon bond, but with semi-annual payments. And if we look over here to the right, we've got one payment at a half a year, a payment at a year, a payment at a year and a half, all the way out to a final payment at the end of year 5, and then a final payment of the par value or face value of $1,000. So this is what our timeline looks like. Now, what can we do with this information? Well, notice that the coupons are half the size of the annual coupon because they're every 6 months. And so let's suppose that in our situation that the yield to maturity on such a bond, the annual yield to maturity is 7%. Then what is the price? Well, the first thing to note is that we don't really need annual rates. We need a 6-month rate. So if we get a 6-month rate, then a 6-month rate is half of the annual rate. And so the yield to maturity will be 7% divided by 2, or 3.5%. How do we implement that in our calculations? We've got a par value of 1,000. We've got 5 years to maturity. Our annual coupon is 6%, but I'm noting here in my Excel spreadsheet that these are semi-annual payments. And if we have you always want to make it clear in your spreadsheet what you're looking at. And let's assume that our yield to maturity is 7%, and I'm going to call that an annual rate so that it's really, really clear. This is our annual rate. So how do we figure out the price? So remember, the Excel spreadsheet, the Excel function PV uses first off the discount rate. The first thing is the discount rate. That discount rate is the yield to maturity, and that's 7% a year, but that's 7% a year divided by 2, or 7%, I divide by 2 here, or 3.5% every 6 months. That's important to recognize. If this is a semi-annual bond, the annual yield to maturity is half of that. The semi-annual yield to maturity is half of the annual one. So you've got to divide the rate by 2. Our number of periods, so here we have number of periods, for the bond is not 5, it's rather 5 times 2. It's 10 half-year periods. Our coupon rate, our coupons, that would be the $60 a year, but it's half of that every 6 months. And so we have 1,000 times 6%. That's the $60 a year, and divide by 2. And I would encourage you to do it just like this inside your Excel formulas so that it is abundantly clear what you have done. And then finally, the final payment, the future value, is the $1,000 up here at the very top. And this is an ordinary annuity, and so we have 0 here for the type. Now, when I press enter, of course, we have a negative number because we're using the PV function, and we have positive payments. And so how much must we pay? $958.42 in order to receive these cash flows. And notice this is a little bit different from the situation that we had. Let's go back over here, make this 7% when we had annual payments. If you have annual payments and the yield to maturity is 7%, then it's worth $959. If you have semi-annual payments, then it's worth $958.42. And you might say, oh, well, that's not very much different. Why do we have to mess with it? Well, that's a lot different if you multiply by $100 million and you're looking at a $1.50 difference on a $1,000 investment. That's a big deal when you start adding a bunch of zeros to it. So it is very important that you identify whether or not your bonds are annual payment or semi-annual payments, and do the appropriate calculations for those. Most bonds are semi-annual bonds, and when we teach this to Principles of Finance, we start off with annual bonds just because that's easier to do pedagogically, but quickly move into semi-annual payments because that's realistically what always happens. All right, now let's do one other calculation, and that is the yield to maturity calculation. So suppose that you have this same bond. We have $1,000 6% coupon bond with semi-annual payments, so $1,000 par value, 5 years to maturity, 6% annual coupons, but with semi-annual payments. So when we say a 6% coupon bond, what we mean is what are the annual payments, but we note that they are with semi-annual payments. Let's suppose that the price is $900. Then what's the yield to maturity? Well, let's talk about this for a second. All right, to calculate a yield to maturity, we need the rate function. And in order to use the rate function, we need the number of periods, and that's going to be the 5 years times 2 to get semi-annual periods. We need the payment, which is, of course, the $1,000 times the 6%, but divided by 2 because it's semi-annual payments. We need the price. The price is $1,000, and we need it to be a negative number. It's $900. The price is $900, and we need it to be a negative number. So here's our negative $900. Notice I have a negative sign in front of that. And then we also need the final value, the par value or the face value, to be $1,000. So all of this looks like just what we did with pretty much like what we did with the rate function for annual bonds. But notice the answer to this that I've highlighted, the answer to the part here that I've highlighted, is going to be a semi-annual rate. It's going to be a rate of return every 6 months. That's not the answer we want. We want the rate of return every year, and so our convention is to convert a 6-month rate into an annual rate by multiplying by 2. So you have to take that answer, which is going to be it's going to be a 6-month rate, multiply it by 2 to get the annual rate, and that gives us 8.5%. Now, let me leave it there and let you look at that for a second. That's 8.5%. The answer is $1,000 5-year bond, 6% coupon with semi-annual payments, trading for $900, has a yield to maturity of 8.5%. And that is a little bit different from the situation if you only had annual rates. If you had annual payments, then it was 8.54%, not 8.50%. And then finally, if you had calculated this incorrectly and forgotten to multiply by 2, let me just go ahead and delete the multiply by 2 part, then you'd have gotten a number. It would have looked like a number, but it would have been wrong. That would have only been the 6-month rate. You have to remember to multiply by 2 in order to get the annual rate.